Everyone wants to know the same thing. Will property prices go up or down? When should I buy? Will I lose money if I purchase now? These are the questions keeping home buyers and investors awake at night. The problem is that most property predictions are either completely wrong or so vague they're useless. Real estate agents will always say prices will keep going up because that's their job. Doomsayers will always predict a crash. Economic commentators confidently state contradictory forecasts. Meanwhile, actual data sits in the background, ignored. I'm going to show you exactly what the data says about Australian property price movements, what patterns we can identify, and what realistic predictions emerge when you actually analyze the numbers instead of relying on guessing. This isn't going to be a crystal ball prediction claiming certainty about something inherently uncertain. Instead, it's a data-driven analysis of patterns, trends, and probabilities. By the end, you'll understand what property prices are likely to do, what could change that, and how confident we can actually be about these predictions. Let's start with the most important question. What actually drives property prices? The core drivers, what we know from data. Property prices move based on supply and demand, modified by credit conditions and sentiment. When you actually analyze decades of data, clear patterns emerge. Demand drivers. Population growth is the primary demand driver. Every additional person needs somewhere to live. Australia's population has grown about 1.3 to 1.6% annually over the past 2 decades. This growth, combined with declining household sizes, creates baseline demand for new housing. Over the past 5 years, population growth accelerated to about 2% annually due to higher immigration. This is why demand has been stronger recently. However, this growth has been uneven. Sydney, Melbourne, and Brisbane received the bulk of new arrivals, while smaller cities and regional areas received less. Employment and wage growth drives purchasing power. The data shows a strong correlation between employment growth and property prices 3 to 6 months later. When unemployment falls and wages rise, property prices tend to accelerate. When unemployment rises, property prices tend to stagnate or fall. Interest rates dramatically affect purchasing power. When rates fall by 0.25%, typical borrowers can afford about $35,000 more in property. This gets capitalized into prices almost immediately. The data shows property prices move in the opposite direction to interest rate changes with remarkable consistency. Immigration and overseas buyers add demand, particularly for units and in specific locations like Sydney and Melbourne CBD. However, the data suggests this effect is smaller than commonly believed, probably accounting for no more than 5% of price movements. Supply drivers. Housing supply is the constraint that determines whether demand gets capitalized into prices or volumes. When supply is tight, rising demand goes into prices. When supply is abundant, demand goes into volumes. More sales at stable prices. Building approvals are a leading indicator. Approvals lead actual housing completion by about 18 to 24 months. When approvals spike, it predicts higher supply coming in about 2 years. When approvals drop, it predicts supply constraints coming ahead. The data shows building approvals have been declining since 2022. We approved 200,000 dwellings in 2022, but only 163,000 in 2024. This declining approval rate predicts tighter supply from 2026 onwards. Construction costs dramatically affect supply. When building costs are high relative to property values, fewer projects are built. Developers won't build if they can't achieve acceptable profit margins. The data shows construction cost inflation has been running 8 to 12% annually since 2020, much higher than property price growth in most markets. Labor and material availability constrain supply. When tradies are scarce and materials are expensive, construction slows. The data shows construction industry constraints are easing slightly in 2025 as demand moderates, but they remain historically tight. Credit conditions. Interest rates and credit availability determine how much people can borrow and thus how much they can pay for property. The relationship is direct and quantifiable. When the RBA cut rates from 4.35% to 3.6% in 2025, borrowing capacity increased by roughly 8 to 10%. The data predicts this should add 5 to 6% to property prices over 12 to 18 months, but not immediately. Credit conditions also matter. When banks tighten lending standards, fewer people can borrow, reducing demand. Conversely, when banks relax standards and offer high loan-to-value ratios, lending increases. The data shows credit conditions were very relaxed in 2020-2021, driving the boom, then tightened significantly in 2022-2023. Sentiment and expectations. Property price sentiment can amplify or dampen fundamental drivers. When buyers believe prices will keep rising, they bid more aggressively. When they believe prices will fall, they hold back. The data shows sentiment matters, but it typically follows fundamentals rather than leading them. Booms aren't created by optimism. Optimism emerges when rising prices are driven by fundamentals. Crashes aren't caused by pessimism. Pessimism emerges when prices are falling due to fundamental weakness. This is important because it suggests sentiment can't sustain prices if fundamentals don't support them, and it can't prevent prices from rising if fundamentals are strong. Historical patterns, what the data reveals. Now let's look at what patterns emerge when you analyze decades of actual Australian property price data. Pattern 1. Boom-bust cycles last about 7 to 10 years. Australian property moves in cycles. A complete cycle from peak to peak takes about 7 to 10 years. There's typically a growth phase, 3 to 4 years, a peak period, 1 year, a decline phase, 2 to 3 years, and a recovery phase, 1 to 2 years. The data shows 1980s boom followed by 1990 to 1991 recession. 1990s recovery and growth peaking around 1995. Mid-1990s correction bottoming around 1996 to 1997. Late 1990s and 2000s boom peaking around 2007. 2008-2009 global financial crisis caused decline. 2010s recovery and growth with a brief 2018-19 decline. 2020 to 2023 post-COVID boom. 2023 to 2025 moderation phase. Each cycle has unique characteristics, but the overall pattern is remarkably consistent. We boom, we correct, we recover, we boom again. Pattern 2. Regional cycles are not synchronized. All Australian cities don't move together. The data shows regional variation is enormous. Sydney and Melbourne often lead the cycle. They peak first and bottom first. Brisbane, Perth, and Adelaide typically lag Sydney and Melbourne by 18 to 36 months. Smaller cities and regional areas vary widely based on local factors. This matters for predictions. When Sydney prices are falling, it often predicts Melbourne will fall in 6 to 12 months, but Brisbane might still be rising for another year. Pattern 3. Large falls are rare, but they happen. The data shows Australian property has never had a truly catastrophic nationwide crash. The worst declines were early 1990s, about 8 to 12% decline from peak. 2008-2009 GFC, about 5 to 7% decline nationally, worse in some regions. 2018 to 19, modest declines of 2 to 4% in Sydney and Melbourne. Falls of 15 to 20% happen regionally, but rarely nationwide. Very large crashes of 30+% simply haven't occurred in modern Australian history. This doesn't mean they can't happen, but it means the baseline scenario should be modest declines in correction phases, not catastrophic crashes. Expecting 30% price falls is unrealistic based on historical patterns. Pattern 5. Growth rarely exceeds 10% annually long term. While we've seen spectacular years like 2020 to 2021 with 20% plus growth, the data shows sustainable long-term growth averages 4 to 6% annually. From 1980 to 2024, Australian property prices grew at about 5% per year in real terms, adjusted for inflation, and about 7 to 8% in nominal terms, not adjusted for inflation. The booms where we see 15 to 20% annual growth never sustain for more than 2 to 3 years. They're always followed by extended periods of slower growth or modest declines that average out to the 5 to 6% long-term trend. This is important because it means extrapolating recent hot markets forward at boom-era growth rates is almost certainly wrong. Pattern 5. Interest rates are the strongest short-term predictor. When you correlate property price movements with interest rate movements, the relationship is remarkably strong. The data shows rate cuts lead to price increases within 3 to 6 months. Rate rises lead to price slowdowns or declines within 3 to 6 months. The magnitude of price moves is roughly proportional to the magnitude of rate changes. The effect is stronger in already expensive markets like Sydney and Melbourne. This is one of the most reliable patterns in the data. When the RBA cuts rates, you can almost predict with confidence that property prices will rise in the following 6 to 12 months, assuming other factors don't deteriorate. Current data. Where are we now? Let's apply this analysis to the current situation in October 2025. What does the data tell us? The growth phase is ending. We've been in a recovery phase since the 2023-2024 slowdown. Growth has resumed, but it's moderating from the post-COVID boom levels. Domain forecasts suggest 4 to 6% growth nationally in 2025-2026. Growth rates are slowing from the 15+% we saw in 2021-2022. Looking at the cycle data, we appear to be in the mid-growth phase, transitioning to late growth phase. We're probably 2 to 3 years away from another peak, but the boom years are definitely behind us. Interest rates are falling. The RBA has cut rates 3 times in 2025, from 4.35% to 3.6%. Based on inflation data, most economists expect at least 1 or 2 more cuts in 2026. Some predict rates could fall to 2.6% to 3.1% by 2027. Historically, falling rates have predicted rising prices with a 3 to 6 month lag. This predicts stronger property price growth in late 2025 and through 2026. However, current rate cuts are from historically high levels, not from emergency low levels like 2020-2021. The boost to borrowing capacity from falling from 4.35% to 3.1% is significant, but not as dramatic as falling from 3.5% to 0.1% in 2020. Supply remains constrained. Dwelling approvals have fallen from 200,000 in 2022 to 163,000 in 2024. This declining trend predicts tighter supply conditions from 2026 onwards. Construction costs remain elevated relative to property values, making many projects unviable. This structural constraint will persist. The data predicts supply will remain tight through to 2030, which supports ongoing price growth. Demand is solid, but not explosive. Population growth is running about 2% annually, above the long-term trend of 1.3 to 1.6%. This elevated growth supports demand. Employment is strong, with unemployment around 4%, historically low. This supports buyer confidence and purchasing power. However, wage growth is moderate at 3 to 4% annually. Wage growth isn't strong enough to match population growth fully, which maintains some affordability pressure. Sentiment is cautiously optimistic. After the 2023-2024 slowdown, when many feared a crash, the resumption of growth in late 2024 and 2025 has restored buyer confidence. However, sentiment isn't euphoric like it was in 2021-2022. Buyers are more cautious. This suggests we're not at the manic peak of the cycle. Data-based predictions 2026-2030. Based on this analysis of patterns, current data, and drivers, here's what the data suggests for property prices over the next 5 years. National level forecast. The data predicts national median property prices will grow at an average of 4 to 6% annually through to 2030. This would take the national median from $844,000 in 2025 to approximately $1.05 million to $1.08 million by 2030. The growth will not be linear. The data predicts 2025-2026 5 to 6% growth as rate cuts flow through. 2026-2027 4 to 5% growth as momentum moderates. 2027-2028 3 to 4% growth as we approach market peak. 2028-2030 2 to 3% growth followed by modest decline. This follows the typical cycle pattern. We're in the recovery and growth phase now. We'll peak around 2027-2028, then experience a modest correction 2028-2030. Sydney forecast. Sydney's current median house price is $1.7 million. The data suggests Sydney will grow at 5% to 7% annually through 2027, then 3% to 4% through 2030. This would put Sydney house prices at approximately $2.1 million to $2.3 million by 2030. Sydney is less rate sensitive than other markets because buyers are already stretched at current prices. Even lower rates won't enable that many additional buyers. However, Sydney has strong fundamentals with high incomes, strong employment, and limited land supply. The data predicts Sydney will underperform the national average on a percentage basis, but will have absolute price growth due to the high base. Melbourne forecast. Melbourne is currently the weakest performer among major capitals. The median house price is $1.05 million. The data suggests Melbourne has significant recovery potential. It's cheaper than Sydney, Brisbane, and Perth, which seems wrong for Australia's second-largest city. This price gap often closes over time. The data predicts Melbourne will grow at 5 to 7% annually through to 2028, faster than Sydney as it catches up in relative pricing. This would put Melbourne house prices at approximately $1.3 million to $1.4 million by 2030. Brisbane forecast. Brisbane has been the strongest performer recently, with prices up 68% over 5 years. The current median is $935,000. The data shows Brisbane is transitioning from explosive growth to sustainable growth. The boom is moderating. The data predicts Brisbane will grow at 4 to 5% annually through to 2030, which would put Brisbane prices at approximately $1.15 million to $1.25 million by 2030. Brisbane is at a transition point. It's no longer the cheap alternative, but it's not expensive like Sydney. The data suggests continued solid growth, but not the boom-era growth rates of 2021 to 2024. Perth forecast. Perth has surprised with 75% growth over 5 years. The current median is $832,000. The data shows Perth's growth is driven heavily by mining commodity cycles and Western Australian economic strength. This is cyclical, not structural growth. The data predicts Perth will grow at 4 to 5% annually through to 2028, then potentially flatten or decline if mining cycles turn down. This would put Perth at $1 million to $1.1 million by 2030. Perth is the highest risk forecast because it's dependent on commodity cycles and Chinese demand for resources. If these weaken, Perth could underperform significantly. Adelaide forecast. Adelaide has grown 75% over 5 years, similar to Perth, from a much lower base. The current median is $834,000. The data predicts Adelaide will grow at 3 to 4% annually through to 2030 as growth moderates from recent explosive rates. This would put Adelaide at approximately $1 million to $1.1 million by 2030. Adelaide's growth is moderating because affordability constraints are biting. It's no longer cheap compared to other capitals. Now comparing Hobart and Darwin. Hobart boomed during COVID, but is now cooling. The data predicts modest growth of 2 to 3% annually, taking prices from $673,000 to approximately $800,000 to $850,000 by 2030. Darwin is in a boom phase tied to defense spending and infrastructure projects. The data predicts 5 to 7% growth while projects are underway, but cyclical risk is very high. Darwin could stagnate if projects are completed and new ones don't replace them. Risk scenarios when the data could be wrong. These predictions assume current trends continue, but several risks could significantly change outcomes. Recession risk. If Australia enters a significant recession, unemployment rises sharply, and consumer confidence collapses, property prices could decline 10 to 20% from current levels. This is possible, but not the baseline scenario. The data shows recession probability is low in 2025 to 2026, but increases in 2027 to 2028 if inflation reemerges. Interest rate surprise. If inflation proves harder to control and the RBA needs to raise rates instead of cut them, property prices would face downward pressure. Every 0.25% rate rise would reduce borrowing capacity by about $35,000, flowing into lower prices. The data suggests this risk is low in 2025 to 2026, but increases in 2027 to 2028 if inflation reemerges. Supply shock. If building dramatically increases due to planning reforms, oversupply could emerge in some markets, moderating price growth. Alternatively, if restrictions tighten further, supply could become even more constrained, accelerating price growth beyond current predictions. Immigration changes. If immigration is cut significantly, population growth would slow, reducing demand. If immigration increases further, demand would accelerate. The data suggests immigration policy risk is material. Global economic shocks. External shocks like financial crises, trade disruptions, or geopolitical events could impact Australia unexpectedly. These are inherently unpredictable, but the data shows Australia's property market is resilient to most external shocks. Confidence intervals. How certain can we be? Here's the honest part. The data gives us ranges, not certainties. For predictions 1 to 2 years out, the data is quite reliable. Interest rate impacts, momentum, and current conditions are strong predictors. I'd estimate 70 to 80% confidence in 2026-2027 forecasts. For predictions 3 to 5 years out, confidence declines. Cycle turning points are hard to predict precisely. I'd estimate 50 to 65% confidence in 2028-2030 forecasts. For predictions about specific suburbs or neighborhoods, confidence is much lower because local factors dominate. I'd estimate 30 to 50% confidence in specific suburb predictions. The data is better at predicting general direction than specific magnitudes. The data strongly suggests prices will generally rise, but whether they rise 4% or 6% is harder to pinpoint. Practical implications. What this means for you. Based on the data, here's what this means for actual decisions. For first home buyers, the data suggests buying in late 2025 through 2026 is probably the right time. Growth is resuming, rates are falling, and we're not at cycle peaks yet. Waiting for a crash is probably a mistake, as the data shows crashes are rare and modest when they occur. Within this time frame, buy when you're financially ready, not when you think the market is perfect. The data shows trying to time perfectly usually fails. For investors, the data suggests moderate growth of 4 to 6% annually through to 2030, with potential for capital losses 2028-2030 if a correction occurs. This is reasonable, but not spectacular. Focus on strong fundamentals, population growth areas, employment diversity, infrastructure investment, and supply constraints. The data shows these characteristics predict better performance. Don't chase markets that have already boomed hard. The data shows mean reversion is real. Markets that grow 50 to 75% in 5 years tend to grow slower in the next 5 years. For existing owners, the data suggests your property will likely be worth 5 to 7% more in 2026 and 20 to 30% more by 2030. This is good, but not spectacular. Don't make major life decisions based on property appreciation alone. Consider using equity to upgrade, invest in additional properties, or diversify into other investments. The data suggests property appreciation alone won't build massive wealth going forward. Final perspective: data versus certainty. The data gives us strong guidance about Australian property prices. It shows clear patterns, identifiable drivers, and probabilistic outcomes. But it doesn't give us certainty because property markets involve human behavior, which is inherently somewhat unpredictable. What the data does give us is better odds. If you buy quality property in strong fundamentals locations when prices aren't at cycle peaks, the data suggests you'll build wealth over 10+ years. If you chase booming markets at cycle peaks hoping for continued explosive growth, the data suggests you'll likely lose money. The data is useful not for predicting exact prices on exact dates. It's useful for understanding probabilities, recognizing where we are in the cycle, and making decisions with better odds. The next 5 years will probably look roughly like what the data predict: moderate growth, some regional divergence, a cycle peak around 2027-2028, and then moderation or mild correction. But property markets have surprised before and will surprise again. That's what the data tells us. It's not certain, but it's better than guessing.